Hi, my name is Arkadiusz Trzciołek. I am a fixed income strategist at PKO Bank Polski.
We expect the Polish sovereign curve to move steadily higher towards the end of the quarter. We slightly lowered our earlier forecasts for the first quarter of the year and now expect that 2-year yields will approach 1.50%, 5-year 2.40%, and 10-year 3.0%. Amid the key drivers that led us to expect that the rise in Polish yields will be more benign are linked to inflation and MPC actions. The CPI is likely to stay below the central bank's 2.5% target, and let alone its forecast, which called for CPI to average about 3.2% in 2019. Following a much better than expected fiscal performance in 2018, the government plans the deficit to come relatively low. The robust fiscal stance does not call for large bonds issuance to finance expenditures. Rate hikes by the Fed and ECB seems to be pretty much off the table, at least according to what market is pricing in. Nevertheless, some normalization is happening either way, with the Fed trimming its balance sheet and ECB ending net asset purchases last year. This, combined with ongoing geopolitical risks such as trade jitters, economic growth slowdown, Brexit or packed election year, are likely to add to debt market volatility. The interest rate hikes in Poland are no longer priced by the market this year, which now is in line with the MPC stance, which does not plan to adjust rates in the coming quarters. Governor Glapiński suggested that rates could be left unchanged even until 2022, when the MPC's full term expires. Inflation is likely to stay way below the central bank target throughout the first quarter, which is likely to keep pressure on the bonds limited, especially on the short end of the curve. The central budget enjoyed a strong fiscal performance last year, which allowed the deficit to come around 0.5% of GDP, according to the Ministry of Finance estimates. Better than expected budget realization allowed for roughly 34% of pre-financing of this year's borrowing needs. Thus, the debt authorities plan to issue about 30 billion bonds this quarter, slightly less than in the previous period. Nevertheless, we do not expect the long-term yields to go back to December lows, as the net issuance will stay in the positive territory, as redemptions and coupon payments shouldn't exceed 8 billion zlotys. The market is setting the bar for global monetary policy low, with no rates hikes from both the Fed and ECB in 2019, according to traders' bets. Although the authorities have also eased their wording recently, the rate increases are still mentioned, which may leave market exposed to unexpected move, especially if data warrant it. The geopolitical developments also remain key risk, as they have direct impact on investors' sentiment lately. Although the result of political games is hard to predict, heightened volatility will keep investors, especially in the emerging markets, on their toes. Thank you for your attention. In case of any queries, please do not hesitate to contact me.